The broadcast is now starting. All attendees are in listen-only mode.
I want to give a little bit of an update as to who I am, give you some information about myself, and thank, of course, Nonprofits First for putting this on. I hope everyone gets their money's worth, and if you know it was free, we want to thank Nonprofits First for allowing it to be free and the opportunity for us to have the webinar. I am the board chair of Nonprofits First, which means that I have an awesome opportunity to be the servant leader of the organization, and I have a lot of fun doing it. I work with a great board and a great organization with lots of great employees who work really hard to make the nonprofit community better. So I love that role, and I really enjoy getting to be a part of Nonprofits First and serving the nonprofit community, which I'm also passionate about. I work for Daskell Bolton, and we're a firm of about 140 people, and we have 3 offices, Boca, Jupiter, and Sunrise, and I lead our not-for-profit practice with respect to the tax consulting and tax compliance side of not-for-profit. But I always like to share a little bit about what I do, and I'm sure many of you might know, CPAs actually don't do the same thing over and over again. We do never the same thing, and I get to be very entrepreneurial, and I get to do things like marketing, and something that I love is doing webinars or speaking opportunities so that I can share with others and help add value to the nonprofit community through teaching. So that's a lot of fun for me. I'm really passionate about leadership, and I'm really passionate about the nonprofit community. And one of my goals is to really serve others and serve the nonprofit community. So I get to do that. It's a lot of fun. It's a get to, not a got to. So I enjoy that. I wanted to share also, and sort of a shout out, I guess, to some of our clients who are not-for-profit organizations. This is published on our website, and it's a small sampling of our nonprofit clients. So I just wanted to share that with you, and I know some of you are joining today, so a little shout out to everyone who is. Let's move right on to the agenda. We're going to be talking about, first of all, an IRS tax update. So I want to give you a little bit more information about what the IRS is up to and how they're moving forward in different areas. We're also going to talk about how to review a Form 990 as a nonprofit executive. And I know it would be easy for me to get in the minutia and in the details, and we may do that in some other webinars. But this is really at a high level, and I want nonprofit executives to be empowered to review the 990 and not be afraid of it or not think that it's too complex. I want to teach you how to review it as a nonprofit executive. So that's what we're going to do. Also going to talk about the board level review of Form 990 if there are any board members out there or staff members who want to share with their board something they've learned today. We're going to talk about that as well. Also, we're going to touch on the top 5 issues every CEO and CFO should address before signing off on the tax return. For me, this is like if you asked me to lunch or breakfast and you said, Andrew, what are the 5 things I need to know about nonprofit taxes? These are the top 5 that I would give you and we would talk about. So I want to share that with you as well. And then we're going to try to have enough time for questions toward the end so that I can address any of those as well. So feel free to send your questions, I believe, throughout the webinar. And Shari, who's the education coordinator at Nonprofits First, she's going to be compiling those and then giving them to me so that I can answer a few questions at the end. And I'll also have my email address at the end of the presentation so that you can contact me by email if you have specific questions. So let's talk about the IRS tax update. And We're going to touch on three different things: the exempt organization priority guidance, which is basically a report that they issue every year talking about what they're going to do, but of course not giving too many details because they don't want us to know everything. And then we're going to talk about just briefly on an international issue with an FBAR focus, and then of course the new Form 990 due date if you haven't heard of that already. So starting with the priority guidance, the IRS is truly interested in these few areas. So protection of assets, this includes self-dealing issues, excess benefit or private benefit, private inurement. These are things, a few of them we'll talk about later on, or loans to disqualified persons. These are things they're interested in, and how they're sort of making sure organizations are complying relates to using like correspondence audits, which is basically where you get a letter, they talk, or they ask you some questions, they have you fill out some forms, and that's sort of how they assess what you're doing and how you're doing it. Then we have the tax gap, which is your employment taxes, unrelated business income tax liability. These are heavy areas and revenue generators for the IRS, so of course they are looking very closely at those. Next would be the international or oversight on funds outside the U.S. FBAR requirements. The IRS again is using compliance reviews and examinations of returns to determine whether you're being compliant or not. And the IRS has been saying for a couple of years now that their IRS exams, or audits as we would probably typically call them, are moving from project-driven to data-driven. And what that means is that when we e-file these 990s, they get a ton of information from your organization. They're saying it's over 150 data queries from the Form 990 core and schedules. So that includes, they're looking at debt finance property, rental income. If you don't have unrelated business income but you have rental income, or low public support percentages, decrease in net assets. These are things they're tracking, and even though it might seem like the IRS is a little antiquated at times, they do have some good technology bringing in these data queries. I actually think it's over 250 or more data queries that they actually have. Something that's recently come out relates to the, and I don't know if anyone's ever heard of this, but Amazon Web Services is providing publicly disclosed 990 data in XML format. So someone can go and analyze the data from your 990, and the IRS is really publishing this information. So they have a lot more than they might be saying, and I think it's, like I said, more than 250. Their new approach, their data-driven approach, has resulted in 90% change rate on filed returns, which means they're doing an examination or a compliance correspondence check, and 90% of the time they have a change on your return. And then they're also planning to focus on Form 990 PF and 990 EZ in early 2016. Now for the one-time extension change, some of us know that you have two extensions for the Form 990. If you're a calendar year, that means your first due date would have been 5/15, and your second due date would have been 8/15, and your final due date would have been November 15th. Now what we're saying is that for any tax year that ends within the 2016 calendar year, so 1/1/16 through 12/31/16, can now file a one-time extension, which means that if you're a calendar year, you would go from May 15th is your first due date automatically to November 15th, which is something that we've been waiting for, something much easier for organizations, creating less burden on them and their accountants. Now for the international issues, the IRS is focusing on Schedule F, which is where we report international issues. Also an FBAR focus, making sure that organizations are compliant with that. The new FBAR due date is April 15th instead of June 30th like it used to be, with an extension to October 15th. So again, a long-awaited change for one of the due dates. So now I want to move on to reviewing the Form 990 as a nonprofit executive, and I'm going to give you some principles and procedures that you can really hone in on and understand so that we know where we're headed with what we're going to talk about in the more detailed information of reviewing the 990. So some principles: knowing your audience. The 990 is publicly disclosed more than it has ever been before. And so knowing who's reviewing your 990, whether it's your board, it's the press, it is watchdog groups, whatever it might be, we really have to know your audience so that we can tailor the 990 to them. We also want to maximize every possible space on the 990. There's lots of opportunities to do that. Use the Form 990 to reflect on best practices, which means looking at some of those governance questions and the other questions on the 990 that help us to reflect on best practices. Then we have filing a timely and complete and accurate return, which with a 90% change rate when your return is audited, this cannot be overstated. It's really not obvious that you would file a timely, complete, and accurate return. These 990s have over 100 pages of instructions to prepare the form. And so it really is a complex form, and we're only going to touch the surface today. Some procedures you can think about: financial and chief executives should review the most recent Form 990 for accuracy and highlights. We're going to talk about this checklist for a nonprofit executive in reviewing the 990. We're going to go through that in detail. Also, having your marketing folks and development folks reviewing the Form 990 so that they can see how you're presenting the organization. There's a lot of narrative opportunities on the 990, and so we want to get the right people looking at it so it's best utilized. Then determine if an outside consult would be helpful for identifying any issues with your 990. And why does it matter? Like we talked about, it's the most important document you prepare, and it's publicly disclosed more than it ever has been before. Stakeholders reviewing the 990, like we talked about, there are many who are reviewing your 990. It's very easily to access via Charity Navigator or GuideStar or any of the other websites that post them. In addition to that, just transparency and communication. If something is out there, if something were on your website, you want it to be transparent and communicate well. So let's dig into this Executive 990 review checklist. And I am going to send you, I have a PDF copy of this checklist. I'm going to send everyone after the webinar a copy of that so you have it with you and you can actually use it to check off having reviewed these particular items. I hope everyone can see the pictures or the snippets of the returns that I have here on the slide. So right as the first one, page 1, part 1, line 1, ensure the description on this line fits on page 1. It should not have to go to Schedule O. This is page 1 of the return, so we want whoever reviews this part to see what your organization does. We don't want them to have to go to a different schedule. So you can see this example here. It's short and to the point, and it all fits on these 2 lines that are available. Limited admission humane society providing services to over 40,000 cats and dogs each year. Tells the reader exactly what you do. And so if they don't get past page 2 of the return, they'll at least know what you do as an organization. Next one, page 1, part 1, line 6 is your total number of volunteers. Make sure this is accurate and make sure you are including your board members. Some organizations don't have a big volunteer force, but your board members in most cases are volunteers as well, so make sure they are included in this number. Next, we're going to look at page 2. Page 2, part 3, line 1 and 4A. Your organization's full mission should be listed here, and it may have run over to Schedule O. But your program service accomplishments should be reviewed by key staff to ensure proper marketing effort. Now, if you look at this example here, it's from a United Way in Alabama, I think. I pulled this online. You can see that they give very specific metrics. They had more than 100 partners. As part of their free tax prep program, they did 3,482 tax returns with refunds of over $2.4 million for low-income folks. So you can see they use metrics here, and that's very important to catch the eye of your reader and properly prepare the form. The IRS actually requests in the instructions that this be the way you prepare it. You use metrics in this section. Next, we're going to look at page 5, part 5, line 1C. And these are some things that might sound obvious or might seem technical, but I really think they're important. So if an amount exists on line 1A or 1B, which is basically how many 1099s you filed as an organization, we want to answer line 1C as yes. We never want to say no. We never want to say no to complying with something. So we're not going to check no here. We're going to check yes because we did comply with those requirements if they were applicable. Next one is page 6, part 6, section A, line 1A. These are the number of voting members of the governing body as of the end of the year, not just any time during the year. And we'll talk about how that's different from another section in the 990. But just remember that this is as of the end of your fiscal year. So if you're a June 30th year end, that would be the case here or any other year end. Next one is page 6, part 6, section B, lines 11A through 15B. If any of these answers are no, make sure we're looking at these for accuracy. No is not wrong. Let me be clear. No is not a wrong answer for any of these questions. As an example, do you have a written conflict of interest policy? If you don't have one, you can't answer yes. But for the purposes of the IRS, like we talked about, they use this data to make assumptions about your organization. So if I'm in your shoes and if I don't have a conflict of interest policy, probably for the sake of saying yes to this question, I will have a conflict of interest policy. Not to mention it's just good governance for your organization. Some of the other ones are a little more off the wall. Maybe not all organizations have them. Whistleblower policy, document retention and destruction, but these are very easy to come up with. You can ask an advisor for a template, and you can get them very easily instituted into your organization. And that way we're saying yes to all of these important governance-related questions to the IRS. Next, we're going to look at, this is one of the most famous sections of the return, Part 7, is where the board list is listed, officers and their compensation are listed. Now, this differs from what we just talked about, where we have the voting members of the governing body at the end of the fiscal year. This is any time during the fiscal year. So if you have a board member for one day during the year, they're going to be on this list even if they weren't on your board at the end of the year. One of those inconsistencies, within the 990, but this is how it is to be prepared. For Section A, line 1A, we have compensation is reported based upon the calendar year ending with or within the organization's tax year. So if you are a 630, if your year end for your 990 is 6/30/16, then we are reporting on the calendar year that falls within your fiscal year, which would be 12/31/15. So we would report the W-2 or 1099 compensation to anyone who's listed here and who received that compensation. We would report that on the calendar year, and it is box 5 of Form W-2. I don't know if the IRS is matching these to W-2s or not, but I wouldn't be surprised if that's where they're trying to go with it. So we want to make sure that this amount does agree to the box 5 of the W-2. Page 10, Part 9, lines 5, 7, and 10. These are the salary-related lines. You can see them over on the right-hand side. Line 5 is compensation of current officers, directors, trustees, and key employees. And then line 7, other salaries and wages. And then line 10 is payroll taxes. These should represent the true allocation of time for resources for the individuals. So I know many of the organizations who are probably listening are audited. You have audited financial statements, and most, if not all, of my not-for-profit clients have audited financial statements. And the auditors don't necessarily require you, or you are not required to be particularly detailed with your salary allocations. In other words, you can use your salary line as one number and allocate it to program expenses, management expenses, and fundraising expenses. But on the 990, we show salary differently. We break it out by officers versus other salaries. And your other salaries allocation could be very different from your officer allocation. So if your CEO does a lot of fundraising, but the staff work on programs, you're going to have line 5 look very different for the officer line. You'll have more allocated to fundraising, whereas the other salaries and wages line might be more allocated to program. So it's important when you're doing your allocations for your auditors to make sure that you are taking into consideration some of those individual roles as part of your allocation. Try not to use a blanket percentage for just all salaries. That's not going to present very well on the 990. Now, if we look at page 11, which is our balance sheet, these are just some ticking and tying items we want to make sure agree to the audited financial statements. So we're talking about total assets, total liabilities, and then total liabilities and net assets. These are consistency things that I would expect a nonprofit executive to just make sure they're correct. They agree to the audit. There's no reason for them not to. Even by $1, I would have them agree exactly, because if you present your audited financial statements on your website with your 990, it's best just to not have inconsistencies. As a sector, we're open to much public disclosure and scrutiny. So keep it to a minimum if you can, any inconsistencies. Page 12, similar here, page 12, line 10, the line item should agree to the audited financial statements, and that is net assets or fund balances at the end of the year. And then on page 12, lines 2A through 3B, making sure these are accurate are very important. So this is asking about whether you have audited financial statements or reviewed financial statements. So answering these accurately is very important. Also, laying out your process for your audit committee. That's one of the questions here as well. Okay, now I want to talk about the board level review of the Form 990. And I know I probably went through all of that other information pretty quickly, but I think the good meat of our presentation is in the board level review and also the top 5 issues. And I want to make sure we get to everything. So this is a suggested process. It may not be your process. It may not be the best process for your organization, but I want to give sort of a sample process by which I think would provide for the best outcome of having prepared a very good 990. You certainly want your staff to review the 990, whether that's your, and these roles will be different for different size organizations, but your CFO, perhaps another finance person, or like we talked about, even maybe your fundraising and development person or marketing person could review some of the narrative on the 990. Have members of staff review the 990, and then also have it reviewed by your finance or audit committee or both, and have them review it similar to how an executive of the organization would review it, checking those key items. Then the committees can recommend approval to the board of directors. One downfall I see some organizations do is they expect their board members to be educated in the 990 matters and to review and approve the 990. And it can become problematic if the board members aren't real sure what they're looking at. Maybe they haven't attended a webinar like this or something like it so that they have more information about it. The finance or audit committee is going to have the information available to more closely review the 990. So I always tell organizations to consider having the committee approve the 990 and then recommend approval to the board of directors, so the rest of the board would feel comfortable approving it as well. On the 990 itself, it asks you whether the board members receive a copy as part of governance. So because I want you to check that answer yes, and because I think it is a good governance action, I would have every board member receive a copy of the Form 990 before it's filed. And that's probably going to line up with your approval process, but just making sure that's occurring is very important. And that can be by email, doesn't have to be paper copies. It can just be made available to them. Or if you have like a board portal, you could use that as well. Now let's talk about what board members could ask. And I'm not sure how many board members we have on the line, although some of my nonprofit executives, I'm sure, are board members for other organizations. But 3 questions you can ask as a board member about the 990. And these are general, these are for your non-finance committee, non-audit committee board members. They can ask, what does the 990 say about our organization? Well, if you read through it and read the narrative, is it making our organization glow, or is it making our organization not look very good, or is it, what is it doing? What does it say about our organization? I think that's a real important question they could ask and provide feedback for. In what ways could we improve the 990 filing? Maybe they know something that the organization accomplished that they didn't see on there. Maybe it was a big accomplishment during that year. Those are some ways we can improve it. And has the proper process been followed for review and approval of the Form 990? The more comfortable you make your board with the form and the Form 990, the easier it is for them to approve it. So if your finance and audit committees have approved it, they're going to feel fairly comfortable as part of good governance to go ahead and approve the 990. So if I'm a board member, I'm asking, has the proper process been followed? So now I want to dive into the top 5 Form 990 issues. Number 1, does the organization have unrelated business income, exposure? Number 2, is my exempt status protected? Is the public support percentage complete and accurate? Number 3, has all reportable compensation been addressed? Number 4, does the organization have any reportable transactions or relationships? And number 5, do I have nexus in other states? So again, like I was telling you, this is, if you were to invite me to coffee or a lunch, this is, and you said, Andrew, tell me all the things I need to know about the 990, these are the things I would bring up. These are the things we would talk about. I think in this order, although I had some trouble, deciding which ones were more important, but I think it would be in this order. So let's go on to unrelated business income. And when I said earlier that we might do some more detailed webinars in the future through Nonprofits First, unrelated business income is one we could do an entire hour plus on. So this is going to be an overview, but I want nonprofit executives to have the tools to ask the right questions and to know whether they have unrelated business income exposure. And some of the ways to do that is just to go through and see how you could identify potential unrelated business income. You can review your significant revenue accounts, have discussions with finance staff, review the website. Sometimes, actually for all of my clients, I review the website so I can see if they're selling something that has nothing to do with their mission. They're selling whatever it might be, has nothing to do with their mission. That might be a red flag for me to ask the question, what's going on, what are you doing? So a website is a good place to look. Also reviewing board minutes. You can conduct a mock audit internally, probably something for a larger organization, or just do an overall risk assessment for unrelated business income. So again, I want to talk about what some of the areas are and how we get to whether we have unrelated business income or not. And just to be clear, all 3 of the next 3 points must be true before you have unrelated business income. In other words, if you have something that looks like it's a trade or business, but it's not regularly carried on, you probably don't have unrelated business income. And so we'll talk about that, but the next 3 points, there's 2 on this slide, and then the next slide is our 3rd point. All 3 have to be true for this to be the case. So is it a trade or business? Is it commercial in nature? Are there for-profit competitors? Is there a specific profit motive? And to support that, if there's a history, has it made a profit? One of my clients had a gift store and was buying and reselling items that did not relate to their mission, and they were always seeking to make money for the organization. But let me be very clear about where the money goes. Where the money goes, if it goes back to your mission, if it goes to help your constituents, that thought and analysis is irrelevant for determining whether you have unrelated business income. We're always looking at the activity itself. It's never a question of where the money is going. Most unrelated business income is going back to support the organization that is producing it. But that is not the question. The question is the activity itself unrelated business income? So it's a common misconception that where the money goes matters. It does not matter for this analysis. The next hurdle is it regularly carried on? Is it generally similar to comparable commercial activities? Is it recurring only occasionally or sporadically? Fundraising events are actually a good example, because fundraising events, for the most part, even though all the money, like I said, goes to the mission, fundraising events in and of themselves, the activities you're doing, whether it's a dinner or an auction or what have you, the activities are not related to the mission of the organization. And it kind of looks like a trade or business. But in most cases, fundraising events are not regularly carried on by IRS standards. So you are having 2, 3, 4, 5 events per year, you're probably okay. in the sense of it is not regularly carried on. If you have the same fundraising event every week, you could have an issue with unrelated business income. And then the third point that we have to get through is the "is it unrelated" question. There has to be a substantial causal relationship to the achievement of exempt purposes. So if you are selling a product or service to a for-profit and your mission has to do with serving nonprofits, at its surface it would seem that that would not be related, or it would be unrelated. Does it contribute importantly to the accomplishment of the organization's exempt purpose? Of course, all this depends on each case and facts and circumstances. But these are, generalities that that get to the point whether we have unrelated business income or not. So like I said, there's 3 hurdles. The last 2 are on the last slide, and this third one is it unrelated? All 3 have to be true before we even go to the next step. So there are some exceptions. As an example, if substantially all the work done is by volunteers, that is an exception. And 85% has been something that's been tried and true in some court cases related to this issue. So whenever we're talking about substantially, we sort of go off of this idea of 85%. It's sort of arbitrary. It's all we have to go off of. So is substantially all the work done by volunteers? Is it for the convenience of members, students, patients, officers, or employees? What about, is it sale of donated merchandise? You might think of Goodwill. Well, Goodwill does not have unrelated business income for their articles and merchandise that they sell because it's the sale of donated merchandise. Low-cost articles or qualified convention and trade show activities. Does a modification apply or an exclusion? And that would be like dividends, interest, annuities, royalties, rent, capital gains and losses. Generally, these are not considered unrelated business income. They're generally excluded, and there are exceptions to that, but generally they are excluded. For example, if you have rental income on debt-financed property, you may have unrelated business income. S corporations are unique in that any S corporation ownership that an exempt organization has is automatically subject to unrelated business income for the interest, dividends, and just the regular ordinary income associated with it. LLC and partnerships, it would be the ordinary income would be unrelated business income, but the interest and dividends would be under the exclusion or modification. So we talked about unrelated business income. Now we're going to talk about protecting your exempt status and public support as it relates to that. So these are 5 ways to lose your tax-exempt status, which obviously we don't want to do that, but I'm going to give you the ways you could do that. And we're going to try to avoid these. So first one is private benefit and inurement, which you have 2 pieces of this, and it's sort of the details. But benefit, is basically private interest or benefit is not allowed. And then inurement is the income or assets of the organization cannot benefit insiders or, like officers, board members, etc. And these issues are serious, and the IRS takes them very seriously. You can have excise taxes not only on the organization. Excise taxes can also be assessed to a foundation or organization manager or like the CEO or executive director. So these are very serious matters when it comes to private benefit and inurement. Lobbying and political activities, political campaigning, anything like that, is not allowed. Limited lobbying is allowed for a 501c3, but it has to be relatively insubstantial, in relation to your full, the full scope of your organization. You may not know this, but unrelated business income can actually cause you to lose your exempt status. However, that must be pretty substantial. And so we're talking about, again, there have been some court cases that have ruled, 15–20% plus of your revenue, if it's unrelated business income, you could be at risk, for losing your exempt status. And because really the reason or the concept is that you are looking more and more like a business. You're not looking like a nonprofit when, almost 20 or 25% of your revenue is coming from unrelated business income. So when you have unrelated business income, you want to look at the levels in relationship with the size of your organization. Also, the annual reporting obligation. I'm sure none of us have this issue, but I have actually helped clients through this issue where they have they weren't our clients before and they did not file their 990 for 3 consecutive years. If you do that, if you don't file, you will automatically lose your tax-exempt status. And so I've helped organizations reinstate their tax-exempt status. You also have to operate within your exempt purpose. So if you substantially change your exempt purpose or the things that you are doing, if they don't line up with your original application to be exempt, you could be in danger of losing your exempt status. There is a place actually on the 990 on page 2 where you can notify the IRS of significant changes. So that is one mechanism you can use to notify them. If it's a more serious or drastic change, you can also get a private letter ruling for your change in your exempt purpose or what you are working on. So we talked about unrelated business income. We talked about your exempt status, protecting your exempt status, also public support. Now, I know as we look through these slides, and I will also have the slides made available to everyone who's joining us today, but I did include some additional information that I'm not going to go through everything, but I want you as a nonprofit executive to be aware of the higher level and top level issues related to public support. So quick background on public support. Public support is required for you to maintain public charity status. In other words, to maintain your non-private foundation status. You're a public charity because in general you have 33 1/3% of your funding or more is from the public. If there are reasons that it might not be 100% from the public, for example, if you have an unusual grant, this could be a situation where because of the amount of the grant, you could lose your public charity status. But there's this exception, there's this unusual grant provision that allows you to not include that in your public support. Excess contributions are from, you might have donors who've given significantly over the years. They might actually be considered excess contributions. And if they have given excess contributions, what happens is your public support percentage is decreased by the amount that they have exceeded or become excess contributors. And so that's where you start getting below the 100% public support. You might at the surface think you have 100% public support, but if you have, a donor who's been giving to you faithfully over the years, $100,000 a year or something like that, depending on your size, you may have a situation where they are an excess contributor. And most organizations have them, so it's not that you would have something where it's very drastic or something like that, you could very easily have excess contributions, and in fact, I believe most organizations have them. The issue might be that it's not being reported properly on the tax return, which could be an issue. Then we have disqualified persons. These are same thing, very similar concept as excess contributors, except this concept goes all the way back to the organization's inception. So you could have a substantial contributor, which makes that person a disqualified person, and that would not be included in your public support, thereby reducing your public support percentage to less than 100%. So real quick on the public support, the overall idea here is to know and ask the question, do I have these components? Do I have disqualified persons? Do I have excess contributors? And you're going to have to ask your advisor these questions to make sure that you are properly calculating your public support percentage. Because at the end of the day, your public support percentage keeps you as a public charity. So it's very important that it's accurate. Let's move on to reportable compensation. And here within the next probably 7 minutes or so, we're going to try to wrap up and so I can answer a few questions. Reportable compensation. We talked about Part 7 of the return where all the compensation is reported. Basically, anyone who's a trustee, director, officer, key employee, or highest compensated employee, under the definitions, their compensation must be reported. There are different definitions for each, and that's probably outside the scope of our webinar. But I want you to note that you may have these different areas. So key employees, if you look at the chart at the bottom, key employees as an example, if someone at your organization has reportable compensation over $150,000, but it's important to note that that would not be an officer. In most of your cases, I'm sure, your CEO who is an officer, your CFO who is an officer, and maybe some others would be under the current officer, director, or trustee area. They would not be considered key employees. These are other employees who are not officers, directors, or trustees who make over $150,000. And then you have highest compensated employees over 100,000 who make over 100,000. Former officers and former directors and trustees over these amounts must be reported. And keep in mind, if you have someone who, like a CEO who left the organization, resigned, and they were CEO at any time during the tax year, even though they weren't there at the end of the year, you still have to report their compensation, if any. Here we're going to talk about reportable transactions and relationships. So we've talked about, so far, we've talked about unrelated business income. We talked about protecting your exempt status. We talked about public support percentage, making sure that's accurate. We talked about making sure you have reportable compensation that's accurate. And then we also want to talk about, sort of bigger picture, reportable transactions and relationships. Many of these go unreported when they should go reported. So business relationship could occur very easily. Board members providing services, and we won't go into the details, but this could need to be reported on Schedule L. Schedule L has certain thresholds, I think, maybe over $10,000 or something like that. We'd have to look at the details, but you could have a reportable relationship. Also, just family relationships. So if two board members are family members, they might need to be reported on Schedule O. Here's sort of a reminder, but all definitions for status as a TDOKI, or trustees, director, officer, or key employee, these are your voting members of the governing body. Keep in mind that on Part 7 of the return, you're not including folks who don't vote, who don't have voting authority. So if you have honorary board members who don't have voting authority, they should not be included on your 990. And then you have the chief executive and the chief financial. Even if your bylaws don't say that your CEO or executive director is an officer, for 990 purposes, they could be considered an officer because they are the top management official. So be looking at that as well. And then you have related organizations. Usually this is with respect to organizations with significant control. So that's another exempt organization that has significant control over you, or you have significant control over another organization. Also disregarded entities, often organizations, if they're doing unrelated business income, they might have a disregarded entity or an LLC that the organization owns, wholly owns, 100% owner. Those are disregarded entities for tax purposes and would need to be reported on Schedule R as a related organization. Last thing, so the last question, the last of the 5 top issues I want you to know is, do you have state nexus? And I know many organizations in Palm Beach County might focus in Palm Beach County. And you might be in a situation where you only operate and work in Palm Beach County. But also other organizations, some organizations do have activities outside of Florida. And we all probably know that with Florida, you have to register to solicit charitable contributions. Well, 45 states plus DC have some sort of statutory scheme to regulate charitable solicitations. So if you are actively soliciting in a state, and I sort of take the approach of a physical presence, generally speaking. If you have a physical presence, like if you are traveling to Georgia to solicit contributions, or you have an event in Georgia that you are attending. I had a client once who was doing she does some stuff with like folk music and some other things, and they were up in Kentucky and they had an event there. You might be required to register with that state for that event to solicit contributions. If anyone's ever tried to solicit on Palm Beach Island, you know that if you have an event on Palm Beach Island, you have to register. So there are local and state regulations occasionally that you have to comply with. And these are really important because they can result in penalties that are excessive. And I've been able to get a couple of clients out of some of these penalties, but some of them, the states are very revenue hungry. We all know that. And so they are hard on these organizations to actually pay these penalties. It seems crazy, but it does happen. And so I want you to be aware of whether you have out-of-state nexus. Generally, just having a button on your website for donations, if you get one from Kentucky or Georgia or wherever, that's not actively soliciting in another state. You probably do not have a requirement to register in that state. But if you are active there or physically there, you definitely want to talk with your advisor about that. So what are our next steps? We're going to do a full-scale review of your most recently filed Form 990. I would recommend you doing that as a nonprofit executive or board member, and make notes for changes or issues to address with your advisor, and make sure you're asking the questions. These are very important to have accurate and have correctly done. Outline your process for review for the forthcoming 990 and utilize available resources. So I'm going to provide you with a checklist. You're going to be able to use that as part of your review process. You might use these slides for some references and a guide. Utilize those resources. Shoot me an email or give me a call if you have specific questions that I can assist you with. Now I want to move on to questions, and I know we only have a few minutes, but please, if I don't get to your question, please let me know by sending me an email if you have a specific question. My email is there at the bottom, agray@dbllp.com. So please write that down and make sure you send me a note with any questions you may have. Well, it looks like to me we may not have any questions.
Andrew, will be available to
I'm sorry, Shari, say that again.
Will the slides be available?
Yes, I'm going to email two things. I'm going to email to everyone who attended. I'm going to email the checklist, then the nonprofit executive checklist, and then I'm going to email a copy of the slides.
Okay. That was one of our questions.
Great. All right. Well, if we don't have any other questions, thank you again thank you to Nonprofits first of all, and thank you to everyone who attended for coming and for hearing what I had to share on the 990 issues. And please give me a call or send me an email if you have specific questions. Thank you.
Thanks, Andrew.